Joining us on the phone right now is Gerard Cassidy. He's an analyst from RBC Capital Markets. He has an outperform rating on JPMorgan. Gerard, thanks so much for joining us. You know, some parts of this earnings report were a pleasant surprise, in particular the iBanking part of it. You know, the decline was less than expected, but you're seeing the stock down over 1%, almost 2% in the pre-market. What do you think is going on?
Well, when you look at the investment banking results, they're colored by the DVA adjustment, as you just heard from your colleague. And so when you back that out, the investment banking results were, I would say, in line to slightly worse than expected. And again, when we compare them to what they actually reported in the second quarter, you know, the numbers, of course, are down dramatically. So I would say the investment banking results were colored by the DVA credit, which Morgan Stanley and Goldman Sachs will have as well.
Okay, let me get back to Scarlett. You've got something for us?
Yeah, Jamie Dimon just talking about how the bank will handle its Europe issues. We're still getting more details on that. But Gerard, I did want to mention as well, and Betty, that the provision for this quarter was $2.4 billion. That looks to be the highest for this fiscal year. So while the bank is stressing that overall credit trends are improving, the CFO talked about how this is a positive credit trend story. You are seeing that stumble a little bit with the bank putting aside more money for loans potentially going bad, aren't you?
Absolutely. You're absolutely right. That's the other highlight we were going to point out, is the loan loss provision was up way more than we expected, and it was higher than the second quarter level. So the credit provision was higher than expected, even though the non-performing assets declined, which was a positive, but the provision was higher than expected.
Okay, so how much is this going to be a barometer then for the rest of the industry?
When you look at the one area that, of course, is credit, the rest of the industry really doesn't have capital markets, as we all know. Most commercial banks do not do that in their typical banking business. But the provision is something for us to watch for. It came primarily, in our view, from the home equity mortgage area. Obviously, JPMorgan and the other bigger players are struggling with the mortgage area still today. Right. But that's really where the areas were. But it's not commercial. Commercial was outstanding for this company. Growth was real strong. Deposit growth was fabulous. But we did have this credit provision being higher than expected.
And Gerard, I'm looking at what they said about Europe. I mean, they said they made some disclosures on their European exposure. 85% of the firm's exposure is in Italy and Spain. What do you make of that?
This company has been obviously in Europe for years and years, and clearly they're exposed there. But I think when we look at their exposure, it's very manageable. It's not something that we dismiss. It's something we're watching carefully, but it's not anywhere near the level of exposures that the European banks have to those respective countries.
Okay, and just finally, I mean, they did also disclose some news on the headcount front, saying that in their investment banking operations, they reduced headcount by 4%. You expect them to cut more costs, including more layoffs here?
I would think that we're going to see that across the board if the capital markets businesses do not pick up. For the industry will have to go to reducing expenses further, and that would suggest more layoffs for not only JPMorgan Chase, but for the industry as a whole.
Gerard, thank you. Appreciate you joining us. Gerard Cassidy of RBC Capital Markets.